Welcome to Real Estate and Taxes with Lakshay. I will be helping you minimize your taxes. Good afternoon, everyone. Thank you for joining in on my Tuesday session on real estate and taxes. Today's topic is actually 6 tax tips to maximize your refund in 2024. Most of you guys have already booked an appointment with me for filing your taxes, or you might have your tax appointment coming up. If you haven't filed your taxes or you haven't touched base with me yet, book an appointment today, because there's a lot of tax savings, a lot of tax changes that also happen in 2024 that you want to keep an eye out for. So without further ado, let's get started. First and foremost is the claiming of any educational expenses on your taxes. Most of the time we have 2 options to claim educational expenses. One is you reported a tuition form on your taxes, which gives you 15% of however much your tuition was. Maybe you enrolled in Humber College for paying real estate course fees. You get a tuition form at the end of the year from Humber College. You'd report that and you get a 15% tax credit on your taxes. But why not use the second option, where you can claim the entire amount and not just the 15%? Yes, you heard it right. You can actually claim all of the tuition that you have paid rather than just getting a 15% credit by simply claiming it on your statement of business and professional income. This form's name is T2125. So whenever you're filing your taxes, maybe talk to your accountant and suggest them, or if they already don't know, or if you're doing it yourself, this is something to keep in mind for, because this can significantly change your tax liability at the end of the day. Number 2 is work from home method. Most of the people are either in the hybrid mode right now, or they're going to work every day, or even they're working from home. Previously, when you were working from home, you would technically be able to claim $2 per day times the number of days you were home. So that means if you work from home maybe 50 days a year, you will claim $100 on your tax return and reduce your taxes by that. But now in 2024, they have basically discontinued the temporary flat rate method, which used to be $2 per day. Now you would need to technically claim the full amount, which is detailed method. And in order to use the detailed method, you must work at least 50% or like 4 weeks straight in a row from your home, and you need a signed T2200 from your employer allowing you to claim these expenses. Number 3 is first home savings account. We have all heard of the first home savings account. It basically is an account for someone who wants to contribute and save for their first home. If you're a first-time home buyer, you can claim $8,000 to a maximum per year for 5 years on your taxes. All you have to do is contribute $8,000 every year to this registered account, and then you get a tax deduction on your taxes. Most of the time, RRSP used to allow us to do something similar, but RRSP had a limit of however much you earned in prior year. That is the only amount that you can claim in current year. So if you earned $100,000 in prior year, your contribution room is 18% of prior year's income, which is $18,000. For FHSA, it doesn't matter how much you earn. You can actually claim $8,000 regardless of what your income is per year for a maximum of 5 years. So $40,000 of savings that you can contribute. Best part is, for RRSP, you have to repay to the RRSP program. Once you withdraw for your home purchase, you have to repay it year by year. But for home savings account, you don't have to repay it. The account basically closes down when you buy your first home. Now let's move on to number 4. Number 4 is withdrawing money from your own corporation to pay yourself salary versus dividend. When we are basically preparing taxes, I have noticed far too many times that person is paying $10,000 as salary from their corporation to themselves, or paying $0 of salary and all of it as dividends. Both of the options are basically not the best way to minimize taxes. What you want to do is do a mix of both of them. Why? Because when you do a very high salary, you're paying a very high CPP contribution as well as income taxes. There's no point of paying yourself $100,000 from your own corporation. The whole point of incorporating is to reduce taxes. and that can only be done when you stay within the $0 to $40,000 range of income from your own corporation. The second, if you need more money from your corporation, more than 40,000, you should technically be looking at the dividend, because dividend doesn't even have any CPP component. So it basically is a more cost-effective way to pay yourself from your own corporation. So whenever you're looking at withdrawing money from your corporation, you need to basically make sure that you have the right mix of dividend as well as salary in order to minimize your taxes and maximize your tax refund. Number 5 is, this used to be my favorite deduction. It is being phased out. I have basically, if anyone has participated in my previous presentations, this by far I have been the biggest advocate of writing off electric vehicles on your taxes. This write-off allows you to basically, it used to allow $61,000 worth of write-off in 1 year. Yes, you heard it right. $61,000 of depreciation for a car claimed all in 1 year. So it used to reduce your taxes significantly. But now it is being phased out. So I personally use this on my taxes as well, and my wife's taxes. So this is something that I cannot stress enough how it helped me reduce HST as well as personal taxes just by having to purchase the fully electric vehicle. So once again, it's not fully gone yet. You cannot claim the whole 100% depreciation in 1 year. You can claim 75%, but every year it's going to drop. The following year is going to be 50%. So for those of you who are looking to purchase a vehicle and want to minimize on taxes, look into getting a fully electric vehicle because of this rebate on your taxes. Last but not the least, multi-generational home renovation tax credit. This used to be available in the past, but now with the new refundable tax credit available with $7,500, you can technically reduce your taxes significantly. So let's assume you did some $50,000 worth of renovation. 15% of that renovation can be basically used against your tax payable. How? If there's an elderly living at your home and you basically had to do home renovation to kind of make the home more accessible, this is one of those credits that can be actually be used. So home accessibility credit, multi-generational home renovation tax credit, both of them are basically for people that you want to accommodate at home. So for example, your elderly grandparent needed a stairmaster to go up and down from the stairs, so you had to remove the stairs and basically install this. It was a significant cost. You can, if they're living with you, they can there's a blood relation, you can basically claim that renovation expense on your taxes. So some of my final words are, if you don't know, the April 30th is the last day of filing taxes for personal taxes, as well as the payment is due on April 30th. But let's assume you're self-employed, then you have until June 15th to file your taxes. What happens if you don't file your taxes, don't pay your taxes until June 15th? Well, you get charged penalties and interest. So make sure to, whenever you're filing your taxes, to pay installments. CRA says that you can file, if you're self-employed, you can file by June 15th. But what you don't know is the amount that was outstanding for taxes is still due by April 30th. Filing can come later, the paperwork can come later, but any outstanding taxes are still due by April 30th. So make sure to file your taxes on time. There is a late filing penalty of 5% on your 2023 balance owing, and to max, and they basically keep adding 1% for each full month that you don't do after. So very significant tax penalties and interest on outstanding taxes. The interest rate, if you don't pay the CPP and EI contributions on a monthly basis, has risen from 10% to 9% to 10%. So again, very high penalties, very high interest rate if you do not file your taxes and if you don't comply with the CRA rules. Make sure to, even if you don't have the full amount to pay installments. That is what my takeaway would be from today's session. Thank you once again for joining in. For those of you who missed the presentation, there will be a recording saved on my YouTube channel, Real Estate and Taxes. You can watch it later as well.